Hi. So after posting the video about the problem with the 60/40 portfolio in the current environment, I received a lot of questions of like, so what do we do? Okay, we believe you. There's a problem. It doesn't work very well right now, at least from the starting point. So how do we fix it? How do we do better? My name is Gary Mishuras. I'm the managing partner and chief investment officer of Silver Ring Value Partners. I also teach the value investing seminar at the FW Olin Graduate School of Business. And I'm going to try to tell you my thoughts on that. I don't think there's a perfect answer, but I think we can do better. I don't think it's an easy solution. By the way, I don't think the solution is tweaking the portfolio from 60/40 to make 35/65, something like that. That's not it. Because remember, the problem with a 60/40 portfolio is both the 60, which is usually equities, and the 40, which is bonds, are embedding on a multi-decade basis very low rates of return from this point. Now, that might change at some future point in time, but today you're getting pretty much nothing in bonds, and meaning you're losing purchasing power most likely by owning them. And equities are promising a low single digit, maybe mid single digit rate of return at best. So I would say that how do we fix this? And I think the answer is by following up absolute value investing approach. Now, what do I mean absolute value, and why is it even necessary to kind of add the qualifier absolute in front of value, right? Isn't there's just one value investing? Well, yes, in my mind there is, but I think there are a lot of things that people call value investing. So in the relative value investing world, which is kind of where mutual fund lives, and I came from that world. I started my career at a very large firm here in Boston 20 years ago, and so I know the world well. And again, I have many friends there, so that I don't want to be perceived as throwing shade on it. But the way the mentality is the portfolio managers or their bosses have convinced themselves that they have to be fully invested. Why? The real reason is it's easier for their businesses. It's more profitable for them to be that way. They don't have to, they won't lag behind the market and lose client assets. So it's really a business-driven decision. It's not an investment decision, I believe, for most investors. There might be some who are doing this for investment reasons, but I don't think the vast majority is. I think the vast majority just decided that it's an easy mantra to hide behind. Oh, our investors already told us to invest in equities, so we have to stay fully invested in equities. We don't want the market time. And by the way, you don't want the market time. I agree with that. But the alternative to market timing is just having high or at least appropriate absolute thresholds for what investments you're going to make, right? So to market timing works something like this. You say, hey, I think the stock market in the US is going to be up, X% over the next 12 months. So I'm going to, have that so much in equities and so much in say cash. That's market timing because you're betting on what will happen. Here is what I mean by having bottom-up absolute criteria. You can say, hey, I'm only going to invest in a company, in a stock of a company, if it's promising me a annualized rate of return of at least 12. If that is not available, let's say I can't find another investment that fits that criteria, I'm just going to wait and keep my assets in cash until I find something that meets that criteria. So nowhere in there am I saying anything about timing the market or what the market is going to do. I'm just saying, hey, I'm not going to commit my capital for a long-term investment at unattractive terms. And if the terms are unattractive, I'm going to wait. I'm going to wait. I'm going to wait and wait. And then when I see something really attractive, I'm going to make a meaningful investment. And that's very different from what a typical kind of relative value mutual fund does. They're very diversified, much more diversified than they should be. Again, for business reasons, not for investment reasons. They are fully invested most of the time. And if they have cash, it's maybe like 5, 6, 7%. And they are not able to do that, right? So, and the question posed to someone who disagrees is, okay, well, what if everything is vastly overvalued? Like, you're going to just have the portfolio of companies that's the least overvalued, but still overvalued. That's not a good solution. So the reason I think that absolute value investing is a good solution to kind of the 60/40 portfolio problem is, so what is the 60/40 portfolio trying to do, right? It's trying to do probably three things. The first thing is to provide a good return. Because look, if you just wanted safety of principal, you could buy, inflation protected bonds, right? Yeah, principal will be safe. That's fine. You're done. But you don't want to just safety of principal. You want a good return. You don't want to lose too much money. Safety of principal, is important. And then, I think a lot of times the 60-40 portfolio is used for people in retirement. And so that you don't want too much volatility. Now, the third question is, I don't think it's necessary. I think some people psychologically get really upset if they see a paper statement that says your portfolio is down X%. So, the industry, the investment management industry caters to that. And I think what they do is they, try to create products that give the clients what they want. And I think that's wrong. It's like, you wouldn't want to go to a doctor and come in and tell a doctor, hey, I know exactly what I want you to cut out. I want you to take this piece out, and that's it. Presumably, you go into an expert who is a master of their craft, and you telling them, hey, I have a problem. Here's what I'm trying to accomplish. I have a pain here. I want to feel better. How do we solve it, right? And the doctor shouldn't worry about what you want to do. I mean, in terms of, they should care about your, you and your feelings, but not, they shouldn't, let you be the doctor and just, let you essentially be in charge of, what to cut out, what not. They should, at most, they should present you with options and explain the alternative. So the alternative, by the way, the alternative to kind of this relative value approach is an absolute value approach, which means that there will be periods of time where you hold a lot of cash. And so the absolute value approach will be volatile at times. And that's something that if you can't handle that volatility, then it's not a good solution for you. And I don't think that it's a good solution for everyone. But if you can kind of mentally overcome the fear of mark-to-market volatility on paper, and one of the best ways of doing it is just not to look at your statements maybe more than once a year. Or I think for the most part, an absolute value approach accomplishes does a better job actually accomplishing the goals of a 60-40 portfolio. And the reason is that I think that it's just as safe, in my view, because you're not making commitments unless you're very confident in moderate downside and a good margin of safety. And I think it promises a better rate of return because you're not committing capital unless you genuinely believe, based on thorough analysis, that that return is available in a particular investment. So I think that an absolute value approach, if you're an investment professional, I have had a number of financial advisors, investment professionals say, oh, I agree with you, Gary. I had the same thoughts. How do I fix this? So that's an alternative. The big downside is it's not easy. The 60-40 portfolio is used so often because it's easy. It's almost mindless. It frees up the financial advisor to spend all the rest of the time on client service and business development, which is kind of how they run the business a lot of the time. An absolute value approach, on the other hand, is very time intensive. It's skill intensive. So that's the downside, and so not everyone's going to be able to use it. But if you're a professional, who can use it, or if you're an individual investor who can apply it, I think it's going to give you, if properly applied, potentially a better outcome than the 60-40 portfolio. If this video has been helpful to you, please hit like and subscribe to my YouTube channel. Thank you.